what the president has said, Republicans says, we're just not competitive internationally. Our tax rate is too high, and it's discouraging investment in the United States. And if you compare the United States with other rival countries, it's true. Is that a big issue for you as a CEO?
For Loews, because we're primarily a domestic company, it's not as big an issue. But I think for the economy, it's an enormous issue. I think there are two things in the tax bill that will generate tremendous economic growth. One is the fact that overseas dollars will be repatriated back to the United States. And number two, the provisions allowing expensing of capital goods. I think both of those signal that domestic manufacturing will increase significantly. And I think that that the Joint Committee on Taxation that's calling for very little economic effect to come from this tax bill is dead wrong. That they think that economic growth for the next 10 years is going to be 1.9%. I think it's going to be significantly higher. And my guess is that this tax bill, if enacted, will pay for itself.
Explain why that is, because we've had a period where there's a lot of cash on balance sheets for a lot of corporations across the country. And also, the cost of borrowing has been historically low. So if people want to invest in capital plant and equipment, they certainly could do it. Why is it going to change things if we actually cut their taxes?
Because they're going to have the equity. It's not going to be borrowed money. And corporations were playing the tax arbitrage. They were going overseas because taxes are lower there. And then they earned money overseas and it got stuck there. So there are many large companies that are cash poor in the United States, cash rich overseas. They're borrowing here in the United States to pay their dividends. When they're able to bring the money back, they'll continue paying their dividends, but the chances are they will also consider investing here in the States.
Well, before we get to the buyback dividend CapEx story, though, I mean, manufacturing is at its highest level in 2011. It feels like the problem in the U.S. has to do with wages and has to do on the demand side, not the supply side. So you need people to buy stuff, and they need wages to do that.
So wages have been growing. They've started to move up. Part of the problem we have is that all costs have been going up. We saw yesterday the PPI index was up 0.3%, and this morning we're getting the CPI numbers. So the inflation is something that the Fed's going to have to carefully look at.
To be sure. And let's go to the buyback conversation then, because we have a chart that shows that we haven't seen as much buybacks recently as we're sort of used to. They fell for a fifth straight quarter in the third quarter. That's the longest down streak since 2009, 2010. You get extra money from the tax, right? Your companies will get extra money from the tax reform. What do you do with it? Buybacks or CapEx?
Well, even before we got extra money from the tax, we've been buying back shares. We've been out of the market for a while because we thought stocks were just so high. But in fact, in the fourth quarter, so far, we've bought back 2.2 million shares of our own stock because we thought that our shares looked cheap relative to other shares in the market. But in terms of corporations overall, in my opinion, buybacks and dividends aren't a terrible thing. Buybacks and dividends are capitalism's way of recycling cash and capital from cash-rich companies to cash-poor companies. And so when a company repurchases shares, that money is going back to investors who are going to reinvest that money in other businesses. So it's being recycled to businesses that actually need the capital to build.
Yeah, but that's not the money that we're talking about. You still need, like, my mom to be able to have more money to go out and buy, not the investors who are going to get more money from a buyback from Apple. So I'll ask you, how much would you do on buybacks versus CapEx for your firms?
So, like I said, if a firm doesn't have something to invest in, they'll buy back shares, and that capital will then be reinvested by individuals and investors into companies that do need the capital. But I think also that with the decline, with the expensing of capital goods, what we are going to see is that companies are going to be investing more because the government, in lowering the tax rate, has lowered the cost of capital for corporations to invest.
So let me talk about another aspect of tax reform, and that is the state and local tax deductions, which has been a hot issue in Washington, as you know. We actually talked with Jerry Brown, the governor of California, yesterday. He said it's basically declaring war in California and New York. Listen to what he had to say.
As originally drafted, it is meant to punish California for voting for Hillary Clinton. It's meant to punish New York. It's meant to punish Illinois and other states that have taken the effort to raise their state income tax. And remember, what is that for? Half of it goes to education, goes to health care, goes to public health, to combating disease. This is a terrible war on California and New York. And remember, these states that have an income tax are the engine, not the entire engine, but very critical part of America's prosperity.
So, Jim, what effect would this have on your businesses, if any? I mean, Ken Moelis says people are going to move from New York to Florida. Other people say that's not necessarily the case. Is it going to affect your business?
It's not going to affect our business per se. It will dramatically affect New York and California and New Jersey, the states with the highest tax rates. Governor Brown says it's punishment. My view, it's not punishment. It's the result of not having a bipartisan delegation from those states in the House and in the Senate that can look after us. So, yes, New York doesn't have very many Republican representatives and no Republican senators. And guess what? We're not represented in this tax bill. That's the way it is. That's the sad truth.
My co-op's like freaking out. I was telling you that. That's all we're talking about now, my co-op. I want to turn to energy because I love it, and Diamond Offshore is part of your businesses. President Trump said that he might open offshore drilling in the U.S. East Coast, or at least that's what some of the people in the administration are saying. Would you be interested in that?
If they do, in fact, open it, it's going to be ages before it's productive. There are very, very good prospects to be drilled in the Gulf of Mexico, all around the world. Offshore drilling has come to a standstill. And I think the issue first is that oil companies have to get reliquefied, which they are with oil prices at $60 a barrel. And then I think they're going to come pouring back into exploration and production of all sorts. There's been dramatic underinvestment in productive capacity in the oil markets over the past 3 years, and I think sooner rather than later, you will see oil companies starting to allocate more to their capital budgets to drill for oil.
And this brings us full circle to that buybacks CapEx conversation, because the conversation among a lot of E&Ps is, oh no, we're going to do a lot of buybacks. Capital discipline is our name. We'll invest, sure, but we're really going to focus on those capital returns. Do you buy that? Is that actually going to happen?
Listen, in my opinion, they're eating their seed corn. That these are oil and gas companies. If they're not going to be growing their reserves, then down the road they're not going to be able to produce the income that they need in order to pay their dividends and fund their buyback programs.
Oh, fair point. And how much is Loews going to buy backs next year? Do we know?
We'll have to see what happens to the markets. We don't. It's not that I'm not telling you because I don't know. Because I know and I'm not telling you, it's because I truly don't know. We're one of the few companies that are very careful about our buyback programs. We buy back when we think the stock is cheap. We don't buy back a fixed amount every quarter.